Welcome to TSAT. Today we are here in Gurukula Udyoga guide to discuss about the commerce paper for junior lecturers. Myself, Mrs. 𝗹𝗶𝗸𝗃𝗲, Head Department of Commerce from Bhavans Vivekananda College, and my colleague, subject expert, Mrs. 𝗹𝗵𝗓𝗏𝗔𝗍, in charge principal, Emmanuel Degree College. Commerce syllabus basically for junior lecturers consists of 7 different units: financial management, financial accounting and management accounting, cost control, managerial economics, organizational theory and behavior, marketing management, quantitative techniques.
So whenever we are going to prepare this session, whenever we are preparing for the exams, we need to understand that the conceptual knowledge is very important. While preparing, every unit has certain concepts which have to be written. So let us understand that all the concepts pertaining to a particular unit are written down. It could be like if it's a small unit, you may have 10, 20, or even if the unit is bigger, you will have 30. But if we go with preparing to concepts right from the basic of understanding, remembering till applicability, the questions while answering, we would do it very easily, comfortably, and there are high chances of passing the exam.
Now, what exactly are the concepts? What is that we are learning about the concepts? Keep in mind, in every chapter, you are going to have certain terminologies which are very important, definitions, meanings, certain formulas in every unit. These concepts are to be practiced properly. Let's start with the first unit of commerce paper. The first unit basically consists of financial management, meaning, nature, objectives, scope of financial management, capital budgeting process, techniques, sources of funds. Cost of capital includes the cost of various sources of finance. Leverages, both operating leverage and financial leverage are there. The different theories of capital structure, dividend decisions, working capital management, cash receivables, and inventory management.
We will be discussing in this hour the basic questions, all the MCQs, which would be conceptual based to higher order thinking level, which this is only an insight into the subject as to how would we prepare the basics, how we need to go ahead with the preparation of the subject. So when we start with the first question, which statement accurately reflects the meaning of financial management? So that is what I was hinting you a lot. Before starting any chapter, while preparation itself, let us divide it into basic concepts as the meaning, nature, scope. Generally we feel, what would be the use of it? Why do we learn it? Why we need to by heart it? But get this, from there itself, the guide for us or the route map ahead, we would understand how to or what should the answer be. So here when we talk about this, the options given are financial management is limited to profit making organization and does not apply to non-profit organizations. Second one, financial management involves maximizing profits at all costs without considering the shareholders' interest. The third one is financial management is an interdisciplinary field that integrates economics, accounts, business principles, make sound financial decisions. And the fourth objective is it is solely focused on financial reporting and compliance with tax laws. As we know that this subject is an multidisciplinary, interdisciplinary fields which integrates all the subjects. That's the base. The second one, we need to apply business principles for sound financial decisions. So your option would be answer 3.
Let's see the next bit. How does internal rate of return help in capital budgeting decisions? Let me tell you, we all know what IRR is when we are talking about capital budgeting decisions. It basically talks about a point where your NPV is 0. He's given us 4 different options. Look into the option where we have NPV is 0. Let's see there, we have the profitability, it measures profitability, it calculates time it takes to recover the initial investment, identifies the point at which project breaks even, and provides the discount rate at which NPV is 0. So IRR is that particular point basically where we have net present value to be 0.
Let's talk about the next one. So ABC company is planning to undertake a new project that requires an initial investment of a certain amount. The company's capital structure consists of the equity and debt, 60% of equity and 40% of debt. The cost of equity is 12% and the cost of debt is 8%. So here what are they asking us? We need to calculate the weighted average cost of capital. First, how do we calculate the weighted average cost of capital? Weighted average cost of capital is calculated by calculating each element or component separately. We need to calculate cost of equity, we need to calculate cost of debt, we need to calculate cost of preference shares if given, we need to calculate cost of retained earnings also if given. Multiply it with the weights and then you add all this, you would get the answer. So how would we do it here? We say your weight into your cost of equity, your weight is 60% and that is multiplied with the 12%, and then your 40% is multiplied by the 8% of weighted multiplied, and then how do we get your weighted average cost of capital after multiplication gives you an answer of 10.4. So this is very important when we are looking at the applicability part.
How does financial leverage differ from operating leverage? Now we understood a little bit about the capital budgeting decisions. Let us also look into the leverage things. What is that is financial leverage? When you're talking about financial leverage basically talks about the use of the fixed financial cost, such as the amount of interest which is being paid on the debt, an increase in the return on the equity for shareholders. And on the other hand, when you're talking about operating leverages, it involves the use of fixed operating cost, something like rent, depreciation. So basically we are supposed to look into these differences which are there. What are the different options which have been given to us? First option, financial leverage involves the use of fixed financial cost, while operating leverage involves the use of fixed operating cost. So we can rule out all the other options which have been given, because here financial leverage is only talking about financial cost and operating leverage talks about the fixed operating cost.
When we go to the next one, so here after your cost of capital, we are entering the theories. So when we talk about the capital structure theories, we are talking about the pecking order theory. So the question with regards to pecking order theory is, how do firms prioritize their sources of financing? When I talk about how do we prioritize, means from where are we, which one is the best one for us? You have understood the cost of capital. From cost of capital, we go to for next step, that is which one should we prefer. So this surely depends upon the management decision, but apart from that, what is the cost implication to the firm is very, very important. So here we are talking about the pecking order theory. We'll just see what does the pecking order theory consists of. When we talk of the pecking order theory, it talks about the internal financing mode. So what are we talking, what are the internal financing mode? The first priority which internal financing is the retained earnings. That is, whatever you have kept aside for past profits, that earnings are used first. So that doesn't have much of its cost of capital, and then the first source of finance would be that, and then we would use it as a first source of finance, we would use it, and then if it is insufficient, what does they suggest is move to debt financing. So this as a last resort, you look to the other sources of finance. So pecking order theory talks about giving preference to internal financing and your debt financing. So we'll just look at the options given. They prioritize retained earnings followed by debt and then equity. The next one is equity financing followed by debt and finally retained. The third one is debt financing followed by equity and retained earnings. The fourth one is prioritize retained earnings followed by equity and debt. So our preference according to pecking order theory is first one comes with your retained, second comes your debt, and then look at the other sources of finance. So A bit is the right bit.
In the theories, as we understood pecking theory, let us also understand one more theory, which is agency cost theory. What does agency cost theory talk about? So he is asking us, what does agency cost theory propose regarding dividend policies? So what is that? The basic concept here is the agency cost theory suggests that firms should pay low dividends to retain more funds internally and reduce the conflict between equity shareholders and debt holders. So here we are supposed to give importance to the amount, the adjustments or usage with regards to low dividends which are there. So let's go to the options which have been given in this. Firms should pay high dividends to minimize the agency cost between the shareholders and the management? No. Firms should pay low dividends to reduce the agency cost between debt holders and equity holders. This suits the theoretical concept which has been given. And the remaining two, which are there, C bit and D bit, can be ruled out.
Then see, if we look at the capital structure theories, we talk about the net income theory, the operating theory, the Miller-Modgilani theories, right? We'll just look at what is the next in this. What is the central premise of the static trade-off theory of capital structure? So we are talking the central premise. On what is it based? So when we talk about the static trade-off theory, it proposes that firms adjust their capital structure. It strikes a balance between the advantage of debt, that is interest. What is the advantage of debt? You get an interest shield, and the cost associated with financial distress and the potential bankruptcy. By maintaining optimal mix of debt and equity, firm seeks to maximize the overall cost of capital and maximize their value. So this is what the trade-off theory. So we are talking about the trade-off theory. It is talking about the advantages we get as well as how do we have to avoid it also. So when we talk about this, what are the options given to us? It should maintain a consistent capital structure regardless of the market conditions. The cost of equity is lower than the cost of debt, leading to a higher leverage. Absolutely no, because the cost of debt, is the least one, and the leverage here, the financial leverage is there, but still we would get a tax shield on that. Then firms adjust their capital structure to balance benefits and financial distress cost. So we would go with the third one, which is talking about the balance of the tax benefits which your organization would get, only to see that their financial distress cost and removed, we get the benefits out of it.
Let's discuss about M&M theory now. What does M&M theory talk about? It talks basically about the dividend policy, right? Argues that dividend policy does not affect the value of the firm in a perfect capital market. So let's see what are the various options which have been given there. The options which have been given there are A bit, dividend policy does not affect the value of the firm. Firms should always pay dividends to maximize the shareholders' wealth. The cost of equity is higher than the cost of debt. Firms should use a high level of debt to reduce the cost of capital. What does M&M talk basically? He basically talks about the dividend policy which does not affect the value of the firm. So A bit is the right answer.
When we look at the next one, so here we are talking about the efficient inventory management. So we have discussed the M&M capital structure theories, and now we are moving to inventory management. So here we are coming to working capital. We are talking about the inventory. So when we talk about the efficient inventory management, remember whenever we talk about inventory, it involves the right level of inventory which should be maintained to avoid stockouts or excessive carrying cost. You should not stock more, and in the same way, even you should not stock out less, because if you stock out less, you may miss out your orders. If you stock out more, you don't have demand, then naturally that would be a burden on our cost. It would increase. So the efficient management system, inventory management, talks about optimizing the inventory. So how do we can do this? By reducing the cost of goods sold, which directly has a impact on the profit margin. So what is the inventory management impact? Company's financial performance. So the options which are given, it decreases the cost of goods sold and increases the profit margin. We need not even think of the other options, because as the cost of goods sold, the cost comes down, automatically the margin there increases. So that is the best or the main purpose of inventory management.
How can efficient working capital management positively impact a company's cash flow? There are various options which have been given: by increasing the company's long-term investment, reducing the profitability and increasing dividend payments to shareholders, minimizing the company's fixed cost, by optimizing cash conversion cycle and reducing the time between paying suppliers and receiving payments from the customers. See, efficient working capital management naturally would try to reduce the timing which is there and its cost. So debit would be the right option for it.
Now we'll look into the unit 2 contents. Remember, whenever we talk about commerce, commerce is a vast syllabus. So we need to understand that every unit has its own importance. So when we talk about the unit 2, we are talking financial and management accounting, its concepts, conventions. We are talking about the GAAP, the Indian accounting standards, the process, final accounts, depreciation, incomplete records, a single entry, non-trading concerns, financial statement analysis, trend analysis, ratio analysis, fund flow, and then we talk about the marginal and the decision making.
So now we are discussing about financial accounting and management accounting concepts, terminologies which are there. The present liability of an uncertain amount which can be measured reliably by using a substantial degree of estimation. Keep in mind, whenever the liability is known, it's only that you are not sure about the amounts, we basically call it as provision. If it happens that you don't know the liability also, then in that case possibly we would call it as a reserve. I don't know what I'm going to use it for. But if it happens, I'm sure what exactly I am using it for. And I am not very sure how much amount is to be paid. Then you basically call it as a provision. So when you talk about tax, tax becomes a provision. I know I have to pay, but it's only that I'm not sure unless and until my profits are known to me. So here the first answer itself gives you a correct answer for the question which is being raised. What exactly is provision?
We'll look at the next one. So what are the items which are classified as fundamental accounting assumptions? So we are talking about all the following items are classified as a fundamental accounting assumption except. So except what? So remember, whenever we talk about the conventions, mostly conventions, concepts, whenever we teach also, we give an overlook of it. We just leave it and we talk about the basics and we start teaching the problems. But remember, most of the questions do come from your concepts, conventions. Based on that itself, your questions would be based and your problems are also based on these principles only. So whenever we talk about the fundamental accounting assumptions, there are 3 fundamental accounting assumptions which are going concern, consistency and accrual. So here these 3 are correct. Business entity is not a fundamental accounting assumption.
How is the value of stock salvage treated at the time of insurance claim? Now basically I'm talking about the salvage value at the end. How do I treat it? He's given us 4 different options: adding to the value of stock, subtracting from value of stock in to the date of loss, not taking into consideration at all, and then subtract from the insurance claim. We have to understand first, salvage means you're talking about scrap. It is the value which is being received after the sale of stock, that is left after the loss. Therefore, you have to subtract it from that particular value of stock. So, B bit gives you the right answer.
We'll come to our Indian accounting standards. First and foremost thing which we need to understand, accounting standards are many. To by heart them is very, very difficult, but we need to at least know which standard is pertaining to what. That is very important. So here a sample of match of the following has been given. So here Indian accounting standards are given, and on the right you are being given the to what actually it belongs to. So you are talking about Indian accounting standards 101, 109, 16, 36 and 7. So we'll see what 101 pertains to. 101 talks about the first time adoption of Indian accounting standards. So adoption of Indian accounting standards, you go to it, it is Indian accounting standard 101. Then when I talk about 109, what does 109 talk about? It is talking about financial instruments, recognition and measurement. And what does your Ind AS 16 talk about? It is talking about PPE or property, plant and equipment. And remember, you would have bits from this also. PPE, then investments, cash flows. These are very much important, where we need to concentrate while we are preparing for the exam. Then the next one is Ind AS 36. 36 talks about the impairment of assets. Then your AS 7 talks about the statement of cash flows, which is mandatory as a to show a reporting in accounting.
Let's look about some concepts on corporate reporting. So we all know that undoubtedly every organization has to present a true and a fair view to all the stakeholders who are there. Reporting becomes a must. What are the main objectives which are there with regards to reporting? So he's given us so much of options which are there with regards to reporting. But basically, whom are we giving this reporting? We are giving the information to the stakeholders. Stakeholders are not just the shareholders who are there. All those who are being benefited with the company's financial positions basically would be called as the stakeholders. So there the C bit gives you a better option and the right answer which is there. To provide the stakeholders with relevant and reliable information about the company's financial performance and the position, let that be the shareholders, the government, the creditors, banks, all these can be a part of it.
We'll come to the next one, which talks about the comparative analysis. So we are talking the financial decision making. So how does a comparative analysis help in financial decision making? So here when we talk about the comparative financial statements, why are we doing it? How is it useful for decision making? Let's get into the options given to us. It provides insights into industry, trends, competitive positioning, evaluating a company's compliance with accounting standards. Yeah, it is necessary. But what it assesses the effectiveness of marketing strategies employed by the company. It doesn't look only into marketing. We are talking about the overall performance of the company. Then it identified potential areas of improvement, compares financial performance over time. We need, see, financial performance measurement is a mark for us to understand how are we going forward. It's a comparison between the past and the present, and to understand what is the performance of it over the time, so that we could understand how to improve it, and if at all there are some lacunas in it, we would rectify that to see that we get into a better position.
So here I just would like to add that when you're talking about these financial statement analysis, there are different ways of financial statement analysis: comparative analysis, common size analysis, trend analysis, ratio analysis, right? You can also talk about the cash flow analysis which are there. All these are the various ways which we have. So when it happens that you're comparing between either 2 years, you're comparing between 2 different firms, possibly they are of different sizes, then in those cases, comparative analysis gives you a good review. If it happens that the firms are of the same size, if they are of the same capacity, then in that case you have to understand that common size gives you a better picture. And if it happens that you want over the years, not just 2 years, you want many years information, then in that case trend analysis gives an excellent information. So let's go to the next one. As I was telling you, financial statement analysis has different ways of analysis. Cash flows analysis and funds flow analysis are also one of the ways of analysis which are their financial statement. So here he is asking us, how is cash flow and funds flow different? We have to understand, basically the word fund is being defined in 3 different ways. So when you use the word fund, fund in a very popular sense, which is a management sense, is talked only from the viewpoint of working capital. Suppose you look into fund in a very, very broad sense, then fund talks about all the resources, every M which is there. Let that be money, material, machine, every resource which is coming in and which is going out, you talk about each and every change. And when you talk about fund in a very, very narrow sense, I am talking about cash. So he is asking you, what's the difference between these two? So cash flow basically talks about the changes in the cash position, and funds flow talks about the changes in your working capital position which is required for operating an organization.
We will look at, we'll go with the next one. So here we have discussed your trend analysis, we have discussed common size. From there we are entering into decision making now. So when we talk about the techniques of costing, so here it's very important for us to understand the techniques play a major role whenever it is, we have a dilemma as to what decision has to be taken. So when we talk here, see the cost of 1 unit of product or service which would be avoided if that unit were not produced or provided is known as, see we are talking about 1 additional unit. Remember the same word which we use even in economics. Get this. So we are talking marginal, additional. So I am talking marginal or additional. Additional cost of the product, additional cost of 1 unit which is produced. So what are we talking about the marginal? So what are we talking about? We are discussing here a point of marginal costing. Marginal, additional, cost of that 1 unit produced additionally, what would the cost be? Or if I talk about marginal, it could be say from cost of point it is marginal cost, revenue it could be marginal revenue. So in whatever context I put it, marginal is for 1 extra unit which I am producing, what would be the revenue, what would be the cost. So when we talk about say 1 unit of product which would be avoided if that unit were not produced. So if that is not produced, I am talking that 1 additional unit which will not be produced, what would be its impact? So what is the impact here? What are we implementing here? The technique which we use here is nothing but a marginal cost.
So here he is given us different options. Absorption costing, no, absorption costing is total cost, it's not 1 additional cost.
Okay.
Next, fixed cost. Fixed cost is only that cost which doesn't change with the change in production. So here he is asking you cost of 1 unit of production, a additional unit. It means there is a change. Therefore, fixed cost doesn't come into picture. When you talk about marginal cost, you basically are talking only about the variable cost which is there. If I talk about manufacturing cost includes everything. It includes all, fixed cost also as well as variable cost. With that. Yeah. While preparing the statement of marginal cost and contribution, if any factor of production is a key factor, it should be expressed in terms of. Now, first of all, what's a key factor? Key factor is that limiting factor for an organization's profit earning capacity. If it happens that your profits, your sales, the development is at stake due to one important factor, you basically call it as key factor. How do you make decisions on these key factors? On the key factors, the most important point in marginal costing technique is you base all your decisions on contribution only. It's not only this particular key factor. Keep in mind, any decision making technique, you are basically talking about the contribution itself. So when I am talking about key factor, I will take the contribution per unit of that key factor. The key factor can be anything. In some cases it can be raw materials, in some cases it can be the labor time, in some cases the number of units produced, maybe finance also is my limiting factor. So we have to keep in mind what exactly is the contribution per unit of the key factor which we are talking, and then make a decision on it.
Just let me add one point to this.
Yeah.
Whenever we are preparing a statement of marginal cost, we have to understand that the statement starts with your sales minus your variable cost, which gives contribution. To that overall cost, overall contribution, you are deducting your fixed cost.
Correct.
So that is how it is prepared. So contribution is your sales minus your variable cost leads to
Contribution.
Which of the following should not be included in inventory valuation? So here we are talking the inventory valuation. See, previously we were talking about what is inventory and how much we need to maintain. So how do we do? How do we reduce the cost of it? How do we optimize the inventory? That is what is inventory management all about. But here we are talking about the inventory valuation part. So what it should not be included? Your manufacturing overhead cost. Yeah, that naturally is included. Your cash discounts, freight charges. But what is not included is the interest cost which is related to inventory preparation. It's not included in inventory valuation.
So, you know, these are very, very important in the Indian accounting standards. When you learn, just to learn the basic concepts which are there of the main Ind AS, Ind AS 3, Ind AS 7, Ind AS 16, you know, these basically will talk about, you know, in the first para itself, when they talk about objectives, if you're good at that particular objective, it's more than enough. Ind AS will give you a very good picture. You need not go into depth because they are not asking you in depth, they are only asking you the basic concepts which are there.
The application part is mostly highlighted.
Correct.
So once you understand what the objectives are, you would know how to apply it. So whenever you are preparing for the Ind AS, so remember accounting standards, as I already told you, is very difficult to chalk out. But what we can do is write for important AS. You write your objectives. You see what would the applicability of that would be, implication would be. Because this is high order thinking levels which need to be applied, and just concentrate on that a bit. Surely these parts should not be missed out while preparation.
True.
We look about the summary statement of the firm where inflows and outflows. See, whenever we are talking the inflow, I am talking the outflow. Both have to be recorded, and I am preparing a summary. So what is the summary talking about? Summary is talking the cash inflows as well as the cash outflows. So cash inflows and the cash outflows, which statement shows it? Fund flow statement shows about the applications and uses of it. So that doesn't come here. Your material budget talks about your only materials. Production budget is talking about the cost of the production which is taken. I am talking about the inflow of the cash and outflow of the cash. So that is taken care in your cash budget.
Now, when we talk about cost accounting, you know, in material chapter, there are so many techniques which are there. Do go through a little bit of these techniques which are there. Let that be the ABC techniques. ABC techniques is the always best control technique, which is you talk about EOQ, you talk about stock levels,
red analysis, FSN.
Yes, all these are very, very important for us. So let's see, you know, in exam you would have high chances that not necessarily everything should be in a theory form. You know, there are so many bits in which they're also asking us problems.
That's where applicability comes.
Correct. So when you're talking about these applications, please keep in mind, learn the basic things. We are not telling you go into the depth of all these things which are there, but just learn the basic things which are there. So here there is a small question which is being asked on EOQ, economic order quantity or the reorder quantity which is there. Now here he is given us that a manufacturing enterprise monthly consumes 1350 units of raw material at the cost of 20 per unit. Determine its EOQ, giving the ordering cost 2400 and the carrying cost being 30% of the price paid. See, we all know how is EOQ calculated? Under root 2 CO by I. What exactly is C? C is annual consumption. What is O? Ordering cost. What is I? Inventory cost. When I say annual consumption, first point given there is he is talking monthly consumption. Convert it into annual. He is giving you 1350 units monthly. Convert it into annual. Make it 16,000 into 12, 16,200.
This is basically where everybody do a mistake.
Correct.
Because we have to understand it's given annually, weekly, monthly, fortnight. Sometimes fortnight is also given. Just look at that very carefully. It's reading between the lines.
Correct.
Underline that.
So when you're talking, if it's given monthly, multiply with 12, given weekly, multiply with 52 weeks are there. This is what is being considered. Fortnights you're talking, 24 fortnights are there, right? 25 are being taken in some cases. So here, first consumption is multiplied by 12. Then you have the raw material cost is 20 rupees. This he says inventory is 30%. 30% of what? 30% has to be calculated on the price per unit. What is the price per unit given? 20 rupees. So 2 into 16,200 into 2,400 divided by inventory cost. Inventory cost is 30% of 20 rupees, which gives you 6 rupees. Under root of this particular calculation will give you 3,600. So EOQ here is 3,600. Let's go to unit 3. Yeah. So what exactly is there in unit 3? Unit 3 we are talking about cost accounting and control, cost concepts and classification, installation of costing system, elements of cost, material, labor, overheads, the techniques which are involved in costing. See, there would be a little bit of overlapping in management accounting and cost accounting. Just because management accounting was given as a previous unit, we had to do a little bit of overlapping because, basically, we use the terms which says economics is the mother of commerce and commerce is the mother of management. So, it's such that management has come from, commerce, certain concepts which are very important from the management point of view. So, here little bit overlapping is there. Then the techniques which are being used, marginal costing, your CVP, cost volume profit analysis, standard costing, budgetary control, uniform costing. These are basically the techniques which are being used. And at the end, not to forget cost control, cost reduction and cost audit, which are the main objectives which are there for costing.
This all helps us in decision making.
Correct.
And management audit is totally related to, helping
Internal
the management. You're helping the management in decision making.
True.
That's why costing comes into picture.
True.
We'll just look at what is from here we start. So, which method of costing is suitable for industries where continuous production occurs? So, we are talking about the continuous production. So, wherever the continuous production, like I say, you have one after the other, stage 1, stage 2, stage 3, stage 4. Suppose I talk with a thread, a yarn. So, right from your ginning, right, you again a seed from the seed is separated from its cotton, and then the thing is taken out, it's graded, and then your yarn is made. So, this is how stages go. So, we are talking about stages, a continuous production. So, job costing, remember, is only for a particular job. Suppose you are taking a vehicle for a repair. What are we doing? See, for every vehicle we take for a repair, different costing is given. It's not the same way where the person says it is 200. Suppose I have taken my car, it's 5,000. She has brought her car, you say 6,000. You can't fight with them telling that how can it be same? How is it different? It can be same.
Correct.
But depending upon my condition of the vehicle, the costing is done. So, job costing comes to that. Batch costing, especially related, take your food products, take chocolates, chocolate manufacturing, or go with medicines. They deal with pharmas, deal with batch costing because a particular batch is done for a particular production. Say I want to go with say paracetamol tablets. Paracetamol tablets is a batch. So that particular, so that's why if you look at the back of the sheet, you would be given as that particular batch number is given.
Will be given. True.
So batch is going with a particular batch where the whole lot is manufactured. Contract, as you already know, contract goes with, it's not restricted for a certain period. It may continue for 2-3 years also. So here it talks about construction industries. Then process, yes, it's a continuous process, one after the other. From one, the unit goes to the next stage. Means the closing stock of one process would go to the other stage as a opening stock. Then there would be a closing stock in that, which would be the opening stock for the other stage. So this is process costing. So the answer would be process costing.
Yeah, here I just would like to add that basically methods of costing, which are there, are three different methods. One is specific order costing, second one is continuous costing, third is multiple costing. What exactly is specific order costing? Costing for a specific order. So all the first three bits which have been given are specific order costing. They are only when the order is placed. And the continuous costing involves process costing, unit costing industries, correct, transport industries. If it happens that you're matching any of these methods and applying more than one method, then you put it under multiple costing. So I just wanted to add that in this particular bit. Now let's go about the concepts and concepts which are there in cost. Let me tell you, cost can be classified in different ways. There are many types of cost. Just go through the meanings which are there of each and every cost. So here he's given us which cost concept refers to the costs that have already been incurred and cannot be changed by future decision. It means you've made the decision, you can't make changes in it. What is that which can't be changed? Now he's given us four options. One is opportunity cost. What is opportunity cost? The cost of next best alternative. Is he talking about alternatives? No. Sunk cost. What do you mean by sunk cost? Already investment is made, already decision is made. I am not going to make any changes in it. I can't take this for future decisions. It's done. See the third one, variable cost. Variable cost is the cost which keeps changing depending with the production.
Varies with production.
Varies with production. And so is marginal cost. Marginal cost and variable cost are one and the same. So what's the right answer here? Sunk cost is the right answer here.
When we'll go to the next one, how does activity-based costing differ from the traditional costing method? So when we talk about activity-based costing, let us understand what exactly is activity-based costing. Allocating overhead cost based on the cost drivers.
Correct.
You know, there for specific activities, you have a driver, you have a particular cost. So these specific activities are the drivers. So based on this, you take the cost of that specific cost driver. And then in traditional costing, what are we talking about? We are talking about the allocation of overhead costs, which are determined on a predetermined overhead rate. It is a predetermined rate. The predetermined rate can be based on labor, it could be on machine hours, right? So here when we talk about that is the basic difference between your traditional method and the activity-based costing. Activity-based costing is concentrating on cost drivers, where traditional costing is talking about allocation, overhead based on the predetermined rate. So the answer bit C would be the right apt answer for this question.
Yeah, and you know, there is one more thing. I've seen some of them getting confused with the word ABC. They think ABC means always, it's always best control. No. If he's talking about materials, its ABC is always best control.
That's inventory management.
Exactly. Yeah. And if at all he's talking about overheads, then you are talking about allocation of cost. Then comes activity based. The cost is being allocated. That is why you are supposed to be careful. Is he talking about overheads? Is he talking about materials?
And then here we should remember one more thing. Understand the difference between cost units.
Correct.
What is the cost unit? What are responsibility centers? These things should be understood very carefully. And based on that, we could actually give the answers. The options would be nearing, but surely there would be somewhere you could eliminate them and you could get the right answer.
Right answer.
Right.
Yeah.
And then we come to cost audit now. So remember, just like a financial audit, even a cost audit is very, very important, right? And cost audit is done by the cost auditors. And here what the question is all, why are we doing cost audit? Why do we need to go or conduct a cost audit? Remember, why is costing or cost units or cost units preference is given? A costing system is installed only to understand that cost, you reduce the cost. Today, you know, people are concentrating on something which is called target costing. I want my profit. Correct. And especially you look at the youngsters coming today, the dynamic and the young entrepreneurs, they want their profit margin fixed. When they say this is my profit, then what is that which I would want? I have to, where could I deduct? Can I touch my market price?
No.
Absolutely no, because
Not
my
in our
competitors
control.
would take it.
Correct.
I would lose it. So what do I do there? I need to concentrate only on my costing part, which is there in my hand. So that is where I have to look at how could I save my cost? What are the various ways I could decrease the cost? So what is the main reason, purpose of conducting cost audit? It is to understand or identify the cost saving opportunities, recommend improvements to cost management.
True. Then, now you're talking about variable cost and fixed cost when you are in marginal costing or in direct costing. What it basically says is that basically your expenses which are there are to be classified as variable cost and fixed cost, right? That is one of the assumptions which are there in the technique of marginal costing. So when we are trying to differentiate, there are different methods on the basis of which you can segregate a semi-variable expenditure also into variable cost and fixed cost. So here he is asking us about the calculation which is involved in variable cost per unit. There are different methods. Out of that methods, you also have the comparison method which is there. So if at all he is giving you two different options and he says, now find out how much is the variable cost per unit in the two different options which have been given. He is not giving you how much is fixed cost or how much is the variable cost. He is only giving you two different options and he is asking you to find it out. How do you do that? Bring about the changes which are there in the amount of expenses, divide them with the quantity. And
the activity.
Yes, then what you will get is cost per unit. Keep in mind, fixed cost will not change. So the only thing which changes is variable cost. Therefore, the answer which you're going to get is variable cost per unit. Yeah.
We'll talk about the absorption costing now. Absorption costing, as in the initial session only you have told, that absorption costing is total costing. Marginal, we are talking about only additional cost of the variable cost, but absorption costing talks about the total cost of production for a particular firm. So that's what is absorption
costing. Now let's go to unit 4. Unit 4 basically is about economics. You know, the mother of all the commerce papers which are there. We have to go through the important concepts on managerial economics, demand analysis, production and cost analysis, market structure, perfect and imperfect markets. So how does production analysis contribute to managerial decision making? Now when you're talking about production analysis, it involves evaluating the production process to determine the optimum level of output and resource allocation. So you have to see where exactly in the bits he is talking about the optimum level of output. So look into the third bit. C bit talks about your optimum level of output. Therefore, C bit is the right answer.
Then we'll look at we'll go to the next one. See, remember, whenever we are talking about the microeconomics, managerial economics, right? See, when basically you are starting with the consumer behavior. You talk about the introduction, then look at what the environment which we are working in is, and then you get into the consumer behavior pattern. Then we are getting into the production pattern. Next we go to the cost, because that is where the entrepreneur wants, the organizer wants. He has to maximize his profits. Then which market is going to sell? So here when we talk the consumer behavior, here you know your demand and the supply, right? So here comes the very important question, price elasticity. Remember, whenever we talk, price elasticity plays a major role, and remember, you would surely have at least 2 bits out of price elasticity of demand. It could be anything. It could be with relate to your elastic or inelastic.
Inelastic.
So surely, or how are you measuring it? True. So just look into that in depth, and you understand the concept of elasticity or how to measure it, what exactly it is. It's a responsiveness of change with price and your quantity demanded. So here what the question is, how does the price elasticity of demand influence pricing decisions? So how is it how is it influencing? So here it, as I already told you, it's a responsiveness or percentage of change in demand with respect to the price. So your D bit is the right answer.
So Now just one more bit on price elasticity, because you know that's very important. Elasticity itself is very, very important. And then price elasticity, demand of a product will be more elastic when does it happen that you have higher elasticity? If there are no substitutes, why change the price?
Means that's more. It should be more than one.
Yes.
Take it. It should be your P of E should be more than one.
More than
so how do we go with more than one? So here it's how we need to think of, when I talk about it's more than one, it should be elastic. So remember, here we have to concentrate on that bit and then answer.
Number of substitutes which are there.
And then not only this, you know, whenever we talk about, remember one thing, when preparing, there are certain marks which are allocated to this.
Correct.
We should be very careful while answering the questions.
So, you know, we all should know that 100 questions have been basically given, right, for each paper. There's so many bits to discuss. We made it a point that we thought possibly we can discuss more. Due to shortage of time, we have to understand that while preparing, as already started in the beginning, make it a point that concepts are being touched upon. See that in every subject you bring the concepts which are there.
Write down.
No.
Write down.
Note
This is
it down.
sentence by sentence. Put it across on the paper. You will remember it.
Correct. And then from every subject, whatever the concepts are, keep them aside and then try to search different ways of answering these questions which are there. And you know, the best way of reducing the time for solving each and every bit is practice. It's only practice, right? Make it a point every day you increase the number of bits you solve. If it happens that you try to solve more and more bits, automatically the speed of taking decisions on the options which have been given increases. You know,
we can eliminate what is not being given.
What is not been given.
And
True.
even the marks plays an important role. Just put an insight into the marks also.
Yes. And out of 100 bits which have been given, I would say that make it a point that first, whatever you're very, very sure of, make it a point that those you are answering. Then start analyzing those bits which you do not have an idea at all. But keep in mind, don't touch, you know, any stone unturned. It's your responsibility to check every bit. Possibly as you're learning and reading, you know, there is something which gets into mind and then suddenly it can strike and then you can answer something possibly which you have never solved.
But be careful, there is a negative marking also here.
Negative marking is there. 1/4 is a negative mark for one bit. If one you know, mark you get when you answer it right, if it happens that you're answering it wrong, then 1/4 is gone. So please be very, very careful with the negative markings which are there. Make it a point every day, minimum 30 bits. Don't take much as a target. First you start with 30 bits a day, solve from various sources.
And make it a point from each unit.
Yes. From
what
each
are the basic concepts which are put in? Then start from, you know, basic, like starting with remembering it to the applicability.
Applicability part.
Till there, you start doing it from the lower order thinking level to the higher order. You put that in an order, surely you would be able to do it. So every concept you should be able to touch all that.
True. And you know, in exams and competitive exams, they usually see that the lower order thinking levels which are there are given on an average. It means 50% would always be low order thinking level questions only. Right? Beyond that starts a little bit complicated questions which are there. So first thing I would say is make it a point you are actually on an average half of the questions you're sure, and see that the basic concept questions are being done. So now your confidence increases. From there you see that you are concentrating on all the higher order thinking levels. Hot questions which are there hardly would be some 10-20% questions, right? The medium, a little above your low order thinking and high order thinking, you would have some 30% of the questions which are there.
And start preparing at least 10 to 20 bits in each unit, concepts, concept wise.
Yes.
You will have 150 bits.
Automatically.
Automatically you are done with your 150 to 200 bits practice.
Practice. So, you know, just 30 bits each day would give you a good insight. So,
and I think we have done really a wonderful session as to how would they prepare and what basic things they are. It's like an equipment or weapons needed to go for a fight.
Correct.
So what
Correct.
do we require? How do we protect ourselves? How do we see that we get the best?
True.
So I think this session would be really helpful
Useful,
for them.
Helpful. And you know, I really would thank 𝗬𝗧 for giving such a wonderful opportunity for all the members who actually cannot go for, tutorials or
spend a huge amount. So this is a real opportunity where you can sit and learn everything.
True.
And you need not waste time. Whenever you are comfortable, you can sit and go through it. True. It's a real great opportunity given by the government.
So I thank MHRD, I thank the Gurukula Udyoga guide, which is the 𝗬𝗧, for giving this opportunity to help you all in successfully completing your JLs, and all the best to all the aspirants who are there.
All the best to everyone.
Thank you.